Right now, sitting inside your retirement account, there is a tax bill with your name on it. You did not create it by making a mistake. You did not create it by doing anything wrong. You created it by doing everything right. Every dollar you saved, every contribution you made. Every year you watched that money grow without touching it. All of it was part of a deal you made with the government, and most people never fully understood the terms of that deal until it was too late to do anything about it. The IRS has been patient. They have been waiting quietly in the background for decades while your money grew. But that patience has an expiration date, and when it runs out, what happens next can completely reshape your tax situation in retirement in ways most people never see coming. This is not a distant hypothetical. This is a rule that is already locked into federal law, already tied to your account, and already counting down to the moment it activates. If you have a traditional IRA or a 401k, what we are covering today is not optional reading. It is information you need before the clock runs out. Here is what we are going to cover. We are going to explain exactly what a required minimum distribution is and why the government created this rule in the first place. We are going to walk through the major rule changes that have happened in recent years that are currently causing enormous confusion among retirees and pre-retirees alike. We are going to show you what the penalty looks like in real dollar terms when someone gets this wrong, because the number is genuinely shocking. And then we are going to move into the strategies, the specific tools available to you right now to get ahead of this, reduce the tax damage, and take control of how and when this money gets taxed. Because here is the most important thing to understand before we go any further. This situation is not something that just happens to you while you stand by and watch. It is something you can actively manage, significantly reduce, and in some cases, almost entirely neutralize. But only if you act before the government forces your hand. Let's start at the beginning. A required minimum distribution is exactly what the name says. A withdrawal from your traditional IRA or 401k that the federal government requires you to take, whether you want to or not, whether you need the money or not. To understand why this rule exists, you have to understand the original deal behind tax-deferred retirement accounts. When you contributed money to a traditional IRA or a 401k, you received a tax benefit up front. That money went in before taxes. It grew inside the account without being taxed year after year. Compounding on top of compounding, all sheltered from the IRS. It was genuinely one of the best deals available to working Americans, and for good reason. The government wanted to encourage people to save for retirement, but that deal was never unconditional. The agreement was always this: you get the tax break now, and we get to tax that money later. The required minimum distribution is the mechanism the government built to enforce the second half of that agreement. At a certain age, you are required to start pulling money out of those accounts. And when it comes out, it is treated as ordinary income and taxed accordingly. There is no more deferring. There is no more sheltering. The bill is due. This is not a penalty or a punishment. It is simply the government collecting on a very long-standing arrangement. But the way it interacts with the rest of your retirement income, your Social Security, your other savings, your tax bracket, can create a financial situation that feels like an explosion if you were not prepared for it. That is why this is often called a tax bomb. And that description is more accurate than most people realize. Now let's talk about when this happens, because this is where enormous confusion currently exists and where many retirees are making costly errors. For years, the rule was straightforward. You had to start taking required minimum distributions at age 70 and a half. That was the law for a long time, and most people who planned their retirement during that era built their entire strategy around that number. Then Congress changed it. The age was moved to 72. People adjusted. Financial plans were updated. And then just when that adjustment became the new normal, Congress changed it again. The Secure 2.0 Act introduced a new framework that is now in effect and that every single person with a traditional retirement account needs to understand clearly. Here is how the current system works. If you were born before 1960, your required minimum distributions begin at age 73. If you were born in 1960 or later, you have additional time. Your required minimum distributions do not begin until age 75. Find your birth year and confirm your starting age. Write it down. Put it somewhere you will not forget. Because that date is the foundation of your entire retirement tax timeline, and getting it wrong is not a minor inconvenience. Getting it wrong triggers one of the most painful penalties in the entire tax code. Let's talk about that penalty directly, because most people do not fully appreciate how significant it is until they see the actual numbers. If you fail to take your required minimum distribution by the deadline, the IRS imposes a penalty of 25% on the amount you were supposed to withdraw but did not. To put that in concrete terms, imagine you have built a $1 million traditional IRA over your working life. That is a real achievement and a testament to decades of disciplined saving. Based on IRS distribution tables, your required withdrawal for the year might be approximately $42,000. If you miss that withdrawal, if life gets busy, or you miscalculate the deadline, or you simply were not aware the requirement had begun, the IRS does not just collect the income tax you owe on that money. They add a penalty of $10,500 on top of it, over $10,000 for one missed deadline. And that penalty applies every year you remain out of compliance. For context, that 25% penalty is actually the reduced rate. Before recent changes, the penalty was 50%. The fact that it was lowered does not make it forgiving. It is still one of the steepest penalties the IRS applies to individual taxpayers, and it almost always results from a lack of planning rather than any intentional wrongdoing. People miss this deadline because they did not know it was coming, not because they were trying to avoid anything. And that is exactly why having a clear plan in place matters so much. The good news, and this is critical, is that this penalty is 100% avoidable. Every single dollar of it. No one has to pay it. It exists because people do not plan, and planning is something entirely within your control. Now let's move into the part of this conversation that actually puts money back in your pocket, because understanding the problem is only valuable if it leads you to the solution. There are real strategies available to you right now that can significantly reduce the tax impact of required minimum distributions, and in some cases, restructure your retirement accounts in a way that eliminates the problem almost entirely. The most powerful of these strategies is the Roth conversion. Here is the core idea. Instead of waiting until the government forces money out of your traditional IRA in the form of required minimum distributions, you choose to move money out voluntarily before that point arrives. You take a portion of your traditional IRA, pay the income taxes on it now at your current rate, and transfer that money into a Roth IRA. The money is now inside an account that grows completely tax-free. And here is the part that changes everything about your retirement tax picture. Roth IRAs have no required minimum distributions for the original account owner. None. The government cannot force you to take money out of a Roth IRA. You have taken a future tax liability, money the IRS would eventually force out of your traditional account and tax as income, and converted it into a permanent tax-free asset. The timing of this strategy is what makes it so effective. Many retirees have a window in the early years of retirement, after they stop working but before Social Security payments begin and before required minimum distributions kick in, when their taxable income is relatively low. During that window, your tax bracket may be lower than it has been in years. Converting chunks of your traditional IRA during those years means you pay taxes at a lower rate than you would have if the money came out later as forced distributions. You are essentially choosing to pay a smaller tax bill now to eliminate a larger one later. Done correctly and consistently over several years leading up to your required minimum distribution start date, Roth conversions can dramatically reduce the size of the accounts subject to required minimum distributions, which reduces the forced income those distributions create, which keeps you in a lower tax bracket, which reduces the amount of your Social Security that becomes taxable. The benefits compound on each other in a way that can reshape your entire retirement income picture. Speaking of Social Security and taxes, this connection is something that does not get nearly enough attention. Required minimum distributions do not exist in isolation. When that forced income hits your tax return each year, it raises your total income. And when your total income rises above certain thresholds, a larger percentage of your Social Security benefit becomes subject to federal income tax. This is what financial planners often call the triple threat of required minimum distributions. First, the distribution itself is taxed as ordinary income. Second, it can push you into a higher tax bracket than you would otherwise occupy. Third, it causes more of your Social Security benefit to become taxable at the same time. 3 separate tax consequences from one forced withdrawal. Understanding this interaction is essential to understanding why the stakes of required minimum distribution planning are so much higher than they initially appear. Now, let's talk about another strategy that is particularly powerful for retirees who already give to charitable causes. It is called a qualified charitable distribution, and it offers a tax advantage that is genuinely one of the most efficient available to anyone in retirement. Here is how it works. Instead of taking your required minimum distribution as income and then writing a check to charity from your bank account, you instruct your IRA custodian to send the distribution amount directly to a qualified charitable organization. The money goes straight from your retirement account to the charity. It never passes through your hands. It never appears on your tax return as income. And yet it still fully satisfies your required minimum distribution requirement for the year. To use the same example, if your required withdrawal for the year is $42,000 and you direct that entire amount to a qualifying charity through a qualified charitable distribution, your taxable income does not increase by a single dollar. Compare that to taking the distribution normally, where all $42,000 gets added to your income for the year and taxed accordingly. The difference in your tax bill can be substantial. For someone in a higher tax bracket, directing that distribution to charity rather than to a personal account could save $15,000 or more in federal income taxes in a single year. And beyond the tax savings, the money goes to causes you actually care about. The qualified charitable distribution limit in 2025 is $105,000 per person, giving retirees significant flexibility in how they use this tool. If you are already charitably inclined, there is genuinely no more tax-efficient way to give. Let's also address a strategy that is sometimes overlooked, but that can make a meaningful difference for certain retirees. If you are still working past the age when required minimum distributions would normally begin, and you are still actively contributing to your current employer's 401k plan, you may be able to delay required minimum distributions from that specific account until you actually retire. This exception does not apply to traditional IRAs or to 401k plans from previous employers, but for your current employer's plan, the option may exist. Check with your plan administrator to understand whether this applies to your situation. For retirees who want to keep working and keep growing their retirement savings, this can provide meaningful additional flexibility. Now let's put all of this together into a practical plan you can actually use. The goal here is not to overwhelm you with information. The goal is to give you a clear sequence of steps that moves you from understanding this problem to actively managing it. Step 1 is to map your complete retirement income picture. That means projecting every source of income you expect in retirement, your Social Security benefit, any pension payments, rental income, investment income, everything. Get a realistic estimate of what your baseline income will look like before required minimum distributions enter the picture. Step 2 is to estimate your required minimum distribution amounts. You do not need to be precise to within a dollar. You need a reasonable projection. There are straightforward calculators available at SSA.gov and on most major financial institution websites. Take your estimated account balance, apply the IRS distribution factor for your age, and get a ballpark number. Step 3 is to identify where the risk actually lives. Take your baseline retirement income and add your estimated required minimum distribution on top of it. Look at where that total places you in the federal tax brackets. Does it push you into a higher bracket than you expected? Does it cause more of your Social Security to become taxable? This is the step where the real picture comes into focus and where the urgency of planning becomes impossible to ignore. Step 4 is to match the strategy to your specific situation. If your projected required minimum distributions will push you significantly into higher tax territory, Roth conversions during your lower income years before distributions begin may be the most powerful tool available. If you have charitable intentions, the qualified charitable distribution strategy may allow you to satisfy the requirement without adding a single dollar to your taxable income. If you are still working, the delay option for your current employer plan may give you additional time. The right answer depends on your specific numbers, your timeline, and your financial goals. But the worst answer, by a significant margin, is to do nothing and wait for the government to make these decisions for you. Because that is ultimately what this comes down to. Required minimum distributions are not something that happens in the background while you go about your life. They are a structured, legally mandated event that will directly determine how much of your retirement savings you keep and how much goes to taxes. The retirees who understand this and act on it years in advance are the ones who retain control over their financial future. The ones who ignore it cede that control to the IRS entirely. Your savings took decades to build. The plan to protect them should not be an afterthought. This is Social Security Vault.